This is the current federal tax developments for the week of June the 15th, 2026. Current federal tax developments are brought to you by your state society of CPAs. And I'm at Zollars coming here this week from Phoenix, getting ready to head to New Jersey for the New Jersey Society of CPAs convention. That'll be held this week in Atlantic City. So I'll be there and hopefully back in time to get something recorded for next week. We'll have to see how that works. But in any event, got this week ready to go. So let's take a look at what we have for this week. And one of the key issues here, we got 6 primary topics. I'm going to start by exploring the controversies surrounding the application of the new Section 68 from the One Big Beautiful Bill Act to trusts and estates. We're then going to look at a recent private letter ruling denying a late mark-to-market election due to the IRS's view that there was a hindsight bias available to the taxpayer, and therefore, as is often true in mark-to-market elections, you're almost never getting them late, and this taxpayer didn't either. We're also going to cover a district court decision that vacated the IRS's 5% safe harbor eradication for clean energy projects. It's a little bit late in the game because obviously this is going to be appealed, but we have at least something moving there, I guess, if you've got one of those. We're also going to look at an appellate decision on Section 2036A. We haven't had a good family-limited partnership estate planning case in a while, so this is it. And it's going to be looking at tax-motivated asset transfers. We've also got a tax court case that's dealing with hobby losses under Section 183. And finally, Treasury previewed the new Section 25F Education Freedom Tax Credit, we're calling it. I just kind of call it the federal tuition credit, which is kind of equivalent to the Arizona versions. They're going to talk about the guidance they expect to be issuing, when they expect to be issuing it, and how we'll move forward now. They had announced earlier in the week that they now have, I believe, 27 states that have signed up to be part of this program. So we'll talk a little bit about what this program is, why, you got to see if your state's in or out. Fundamentally, we get to the 1st of 2027 because the states have to register their, qualified entities on that date. So basically, they'll need to be in place then, but we'll talk about that. So let's start with the first major development, which is the sweeping changes that were made to IRS Section 68, what used to be the P's limitation, then disappeared for a while and was restored by the One Big Beautiful Bill Act enacted on July 4th, 2025, but in a very different way it works than it did back in the old P's limit. So this legislation has introduced significant challenges for fiduciaries and tax planners that are attempting to navigate Subchapter J, dealing with income taxation of trusts and estates. Now, the mechanics of this rule reduce deductions by 2/37 of the lesser of your total itemized deductions or the excess of taxable income over the 37% bracket threshold. Now, one key thing that happened with the new 68 versus the old one is the One Big Beautiful Bill Act repealed former Section 68E. That used to have a statutory exclusion that protected trusts and estates from this limitation. So now we know trusts and estates can be hit by this. Now, because the new law lacks explicit coordination with Subchapter J, applying this new Section 68 to fiduciary returns has created a storm of technical ambiguity and a risk of double taxation where both the beneficiary and the estate or trust are effectively paying income taxes on the same dollars. At that case, because we have some other problems that go with long-standing fiduciary income tax principles. The quasi-pass-through nature, it'll become very quasi-pass-through, depending upon how this is done. And why this has come to a head is because of the Joint Committee on Taxation's Blue Book that was issued recently, right? This is their explanation of the One Big Beautiful Bill Act. Now, the Joint Committee on Taxation's logic starts with Section 641B, establishing that an estate or trust computes its taxable income in the same manner as an individual. Now, they skip a little point here that some critics are going to talk about. We'll talk about that in a second. What they skip in this section. They then go directly to Section 63D, which defines itemized deductions as everything not used for AGI under Section 62 or listed in Section 63B. Because unique fiduciary deductions, like the Section 642 personal exemption equivalent, and really important, the Section 651 or 661, depending on whether you have a complex or a simple trust, distribution deductions are not explicitly excluded by either Section 62 or 63B. Based on this, the Joint Committee in the Blue Book tells us that they classify them as itemized deductions that would be subject to this new limitation. Now, let that sink in for a second, because here's the catch. We get the 37% bracket at a very, very low net income level for a trust or estate. And if those are considered itemized deductions, as you might guess, it's going to get a little messy trying to figure out how to get this computed. Now, the Joint Committee does acknowledge that Treasury Regulation Section 1.67-4A1II explicitly states these are not itemized deductions. However, the Joint Committee argues this regulation is legally constrained by the code because the phrase "for purposes of this section" is found in Section 67E describing these extra deductions that we get. Therefore, they conclude that Section 67E only applies to miscellaneous itemized deductions under Section 67 and does not shield fiduciary deductions from the new Section 68. That means all of these special deductions that a trust gets under basically 41, where we're allowed to take in this whole area, subchapter J, none of those are protected. So all of them, because individuals don't get them in computing AGI, because that's Section 62, the Joint Committee just says, well, tough luck. They're by default itemized deductions. Now, we've had some criticisms here. And in fact, an article that also prompted me to look at this was one published in Tax Notes Today on June 8th, written by Justin Miller, and it was "The Fate of a Trust or Estate Under Section 68." Now, as noted, commentators have been highly critical of this interpretation. Justin Miller, in his article, pointed out the Joint Committee on Taxation relies heavily on 641B to apply individual rules for trusts, but, and this is what he complains about, completely ignores the statute's qualifying language that they will be taxed like an individual except as otherwise provided in this part. And otherwise provided in this part are all those special deductions that the Joint Committee is trying to apply the haircut to. Now, this omission has massive downstream effects because trusts hit the bracket at a highly compressed threshold of just over $16,000. Section 68 has a disproportionate impact on trusts and estates. If a trust uses itemized deductions to offset capital gains tax at 20%, the Section 68 limitation inequitably drops the effective tax benefit of those deductions down to roughly 18.92%. Because that's the other problem. Nothing in here says, we care what rate actually applied to your tax. And that can spill over to individuals as well. Furthermore, applying this to Section 651 and 661, the income distribution deduction that a trust or estate gets, basically destroys the whole concept of subchapter J being a kind of conduit. The trust gets taxed on a limited portion of the distribution, while the beneficiary still has to pay tax on their full distribution under Section 652 or 662, resulting in a very literal double taxation of exactly the same income. Then finally, because we have commentary from basically the AICPA, the American Council of Trust and Estate, American College of Trust and Estate Council, ACTEC, and the New York State Bar Association. As the New York State Bar Association pointed out, limiting the distribution deduction creates a maddeningly circular math loop for calculating what is DNI. There's a lot of things where you get circular calculations all over the place. You get into play with interesting algebra. So it's like, this seems to be a total mess. Now, the application of Section 68 also crashes headlong into other established deductions. The Joint Committee Taxation Explanation clearly fails to address Section 642C, which grants trusts an unlimited charitable deduction. Now we get into the language of the statute versus what the Joint Committee is saying. If Section 68 limits a permanent charitable set-aside tax-exempt charities are essentially forced to indirectly bear an income tax burden. Because this tax reduces the amount available for the charity, it triggers a great unworkable algebraic loop. Similarly, limiting the 691C deduction defeats its whole purpose of mitigating double taxation of income with respect to decedent that was also subject to the estate tax. Major professional organizations, including, as I mentioned, the AICPA, the American College of Tax and Estate Counsel, and the New York State Bar Association, are aggressively lobbying for technical corrections. There are basically 3 separate comment letters that have been sent in by each one. Each of those organizations sent a comment letter. However, be aware the New York State Bar Association strongly warned against a blanket expansion of Section 67E to solve this, fearing it could accidentally recharacterize normal administrative expenses as completely non-deductible miscellaneous itemized deductions. So, they got to be careful how you do this thing. Don't just do a quick and dirty patch, because that could cause as many problems as what you're working on. As always, here recently, we now have our infographic here, the visual summary of what we're facing here. And on the left, we see our fiduciary fallout, highlighting how the erosion of the conduit principle leads to double taxation. The DNI circular math loop, which gets into that, and the reclassification of unique fiduciary deductions. On the right, we see the preferential rate and bracket pitfalls, illustrating how the severe compression of 37% limitation threshold at just over $16,000 for trust. It also graphically shows how the effective tax benefit of deductions against long-term capital gains and qualified dividends is diluted if we don't get to exclude that income from this. And there's a whole lot of questions dealing with this. Now, again, the infographic, if you're not watching the video, we do have it available on the website in the copies of the slides. And those copies of slides can be downloaded at the current federaltaxdevelopments.com website. If you go to the page that deals with the weekly updates, audio and video updates, you'll be able to find them there. So let's go on to our second topic now. We're going to turn to the accounting methods in elections. Great fun things, right? We're going to be analyzing Private Letter Ruling 2026-23008 that was issued on June 5th. The ruling serves as an important cautionary tale for practitioners about the strict scrutiny the IRS applies to any request for retroactive relief, but in particular, when you're going to get into these 475 elections to be treated under mark-to-market as a trader because of the hindsight bias. Okay. This is one that we are told flat out, you're unlikely to get this relief. In this case, the taxpayer will discover that, yeah, they got exactly the no relief that we were told you're likely to get. That's kind of how it goes. So the facts of this PLR involve a basically C corporation that was primarily engaged in global manufacturing, but which also began trading securities through an executive. Right? While trading initially saw gains, by the taxable year in question, referred to in the letter ruling as year 2, the taxpayer began losing substantial amounts of money on these securities. Yeah, trading is a good way to take a large fortune and end up with a small fortune. Right? That's how you do it. The taxpayer internal tax department relied heavily on their external accounting firm, as many organizations do. But the external tax advisor failed to mention the opportunity to make a mark-to-market election under Section 675F1. What the mark-to-market election does is it says basically, at the year end, we're going to write all of your positions you're holding, either up or down to market value, and you'll recognize a gain or loss at that point. Now, generally you'd think, well, if we're making money, you wouldn't want to do that, which true would be part of it. But what you gain by doing that is these are all treated as ordinary income. If you're truly a trader, a day trader, you're almost always going to cash every night. You have a huge number of trades, and everything you sell is going to be a short-term capital gain or loss. So if it's all going to be short-term, not having it as a capital gain or loss is generally going to be preferable to having it as not as a capital loss, I should say. Is going to be preferable, and having it not as a capital gain isn't going to really hurt you, right? The problem is the limitations. In the case of a corporation, a C corporation, remember, we can't deduct capital losses unless we have capital gains to offset them, and we don't have that long of a carryover period. This is like doubly bad versus individual. Now, the real problem is this election needs to be made by the unextended due date of the return for the year before you want this new rule to apply. So it's a little bit messy to get there. So the taxpayer only discovered this missed opportunity much later, after that deadline had long passed, when consulting with a different tax partner of the same accounting firm for the following year. Oops, we have a little problem. Okay. Now, to try to fix this missed opportunity, the taxpayer filed a private lettering request seeking an extension of time under Treasury Regulation 301.9100-3. The regulation governs late regulatory elections, and to get relief, the taxpayer must prove they acted reasonably and in good faith, but the reg tells you what that means. Okay? So, the taxpayer's request for the relief for year 2 rested on two main arguments. First, they argued their failure was directly due to a lack of proper advice from their external accounting firm, despite heavy reliance upon them. And second, they argued that the COVID-19 global pandemic significantly hindered and inhibited their tax director from effectively communicating with the external advisors and managing their internal business processes. Now, in a lot of cases, saying, the CPA firm falling on their sword and saying that, hey, yeah, we should have told them, but we didn't, that might get you relief in a lot of cases. 475 has that super early deadline because the IRS has a huge concern with hindsight. Hindsight is always a problem. Are you getting the benefit of hindsight? Do you know things now on the later date? Because remember, you're choosing to ask for relief. Do you know things now on a later date that even if you'd had the advice back then, you wouldn't have known? And the problem is, how the year ends. Do you end up with a big loss or big gain? So that's it. So they're trying to argue that because the outside advisor failed to tell them, and because COVID-19 inhibited their communication with the outside accounting firm, that this should be a special case, and the IRS should allow what they tell you, essentially, they rarely allow. Now, the IRS's analysis of the good faith requirement focused heavily on the prohibition of hindsight. That's not a good place for the IRS to be starting in a case like this, because this is going to be your problem. Under the regulation, the taxpayer is deemed not to have acted in good faith if specific facts have changed since the original deadline that now make the election advantageous. Okay. Remember, you have to elect this by the due date of the unextended return. Let's assume it's a calendar year C Corp for the prior year. So that means by April 15th, I have to make this election. My year doesn't end until, December 31st. I don't know right now if I'm going to be showing net gain, net capital gain, or a net capital loss at the end of the year. Remember, if I don't make this election, these are going to remain capital assets subject to capital gain treatment. I won't get the automatic ordinary income treatment, which means if we have losses, I'm going to be limited to just the gains. Now, the taxpayer tried a creative argument. They say because they're a C corporation subject to a flat tax rate, there's no rate differential between capital gains and ordinary income, meaning the election would theoretically be equally beneficial at any time. Yeah, but no. The IRS completely rejected this. We all know about time value of money, pointing out the massive advantages related to the timing of income recognition. The IRS noted an inherent asymmetric incentive. A taxpayer with net unrealized gains wants to defer taxation and would avoid the mark-to-market election, whereas a taxpayer with unrealized losses wants to make the election to get to use those losses against their other income. Because the taxpayer continued trading for over 9 months past the deadline before seeking relief, they went into the next year, the IRS concluded that they possessed the benefit of hindsight to review their trading results, discover year 2 had been a big loss, and now suddenly this election was way more advantageous because in year 1, when they made money, there'd have been no reason to make this election. You wouldn't have done it. And that's kind of where we end up. And there's a second problem beyond the hindsight. Hindsight's good enough to kill it, but there was another problem too. The taxpayer also has to prove that granting the election won't prejudice the government's interests. For accounting method changes that require a 41A adjustment, that's where you go back and recompute what the adjustments would have been in the past and pick that up as income over potentially 4 years, or pick up the loss right now. The government is automatically presumed to be prejudiced unless the taxpayer can demonstrate unusual and compelling circumstances. Now, this is where the taxpayer tried to use the COVID-19 pandemic stay-at-home orders as their compelling circumstance. The IRS didn't find this persuasive. They noted that the pandemic did not prevent the taxpayer or their advisors from using the internet to research the tax consequence security training. Furthermore, the training had begun well before the pandemic restrictions were in place. This wasn't new. As a result, the IRS denied the request, establishing a strict standard of scrutiny for retroactive accounting changes. You can't explain how the COVID-19 pandemic prevented you from talking with your advisor. Yes, you might not have been in the same room with them. You might have had to do a Zoom conference, or you might have even just used the phone. Believe it or not, phones still work during that. And basically, you should have been able to communicate about this. There really wasn't anything about the pandemic. You're not. It's not like you're a physician treating somebody's illness, who needs to have the patient in the room. You're a CPA, giving advice to a corporation. It's accounting information that's electronic. You can transfer that, and there's no reason why everybody had to be in the same room. And certainly not had to be in the same room to understand the consequences of this. And clearly, it just wasn't thought about. Needless to say, the relief was denied. So, infographic again, we've got it there. On the left side of this, we show why the good faith theory failed, because you had 9 months worth of hindsight. There was a asymmetric incentive depending on whether you had income or not. And timing of income recognition matters. It's a big deal. It's part of tax planning. What exactly is the timing of this? And that's going to be the key issue. So the COVID-19 defense did not give us the extraordinarily high bar to prove unusual and compelling circumstances for making for a retroactive accounting method change. So let's go on to our third development this week. We're looking at the massive shift in clean energy planning. Potentially. The problem is it's coming so late in the game, I'm not sure it's going to matter. But a recent district court decision struck down IRS Notice 2025-42, a notice that had previously upended the beginning of construction rules for renewable energy projects. Okay. The background here is the One Big Beautiful Bill Act shortened the eligibility window for Section 45Y and 48E clean energy tax credits. To qualify, construction must begin by July 4th, 2026, less than a month from now. For over a decade, and actually in other areas, including, we talked about Section 168N, you have two tests to show start of construction. You can either show a physical work test, or you can meet the 5% safe harbor. If you've incurred 5% of the costs are somewhat, we have specific costs that count and don't count. But if you say I've got 5% of the costs have been incurred for a wind or a large solar project, that would qualify you. And like I say, these are also the standard rules for, date, basically the date when you began construction for bonus depreciation rules and other areas. It's what's been noticed consistently. Treasury suddenly issued Notice 2025-42, which simply said the 5% safe harbor for wind and most large solar projects would not count. You couldn't use that here with the thing running out. The IRS mandated that taxpayers rely solely on physical work tests to prevent, in the words of the IRS, the artificial manipulation of eligibility. So we have to kind of look at that. So let's start this and get going. So the background involves this intersection of the Inflation Reduction Act, which put these credits into law, and the One Big Beautiful Bill Act that a couple years later takes them from law. While the IRA created technology neutral clean energy credit, right, the OBBBA shortened the eligibility window for certain types of projects. Under the new rules, for projects that did not begin construction by July 4, 2026, the tax credits are only available if facilities are placed in service by December 31st, 2027. Now, for over a decade, you could prove you'd begun construction on any of these clean energy credit projects by passing either a physical work test or a 5% safe harbor. However, Treasury suddenly issued Notice 2025-42 following the passage of the bill, which completely eliminated the 5% safe harbor for wind and most large solar projects. The IRS mandated reliance solely on the physical work test, asserting this change was necessary to prevent taxpayers from circumventing the statutory termination date and to stop the artificial manipulation of eligibility. Now, again, that's my concern with this somewhat outside of this area is, well, now the IRS is saying the 5% test allows you to artificially manipulate eligibility. Does that mean later that, let's say, we come to a new administration who's looking at 168, looking there at 168N, we get to the point there we have to start construction by a certain date. Are they going to say the same thing? Well, to prevent artificial manipulation, we're not going to follow that if they're not in favor of that. I mean, there are many places this is used. You got to start worrying about. And of course, quite often when you start construction, it doesn't matter. So it's only going to matter when that is a key issue. Okay. Now, in response to this notice, a coalition of environmental organizations, utilities, and tribal corporations filed a lawsuit under the Administrative Procedures Act, or APA, seeking to vacate the notice. The plaintiffs, and they're a mixed group, argued the notice was arbitrary and capricious because it lacked a reasoned basis for departing from longstanding practice and ignored the taxpayer's serious reliance interest. Now, the government went for their strongest, as far as I'm concerned, position first, which is said, well, nobody here has standing. But the court took a broad view of who had standing. They sided with the plaintiffs using common sense economic inferences. The government's going to argue, no, it's got to be a direct interest, to conclude that narrowing these important tax credits would foreseeably cause electricity prices to increase. Well, anybody who pays for electricity apparently would have standing in this case, thereby inflicting concrete economic injury on consumers. Note that state-based litigation limitations, specifically the Mellon Bar, did result in dismissal of the Maryland Office of People's Counsel, as was only asserting the interests of its citizens and quasi-sovereign state interest. So we did lose one in the result here, but mainly it went forward. Now, even with that, we have the Anti-Injunction Act, which generally prohibits lawsuits aimed at restraining the assessment or collection of taxes. The court agreed with the notice's effect on tax liability, brought the suit within the textual reach of the Anti-Injunction Act. But the court applied a crucial carve-out known as the South Carolina exception, which states that the Anti-Injunction Act does not bar an action if the plaintiff has absolutely no alternative avenue to litigate their claim. And this is where the standing part of this becomes more interesting, because remember, most of these people aren't paying a tax. Because many of the plaintiffs were non-taxpayer organizations, they could not file a standard refund suit or deficiency proceeding. They weren't paying any tax here. The court ruled they could not be forced to depend on the mere possibility of persuading a third party to file a refund suit on their behalf, thus allowing the challenge to proceed in time to get these programs redone, to get things in there. Okay. So now the court looked to the merits of the case. This, I think, is by far the government's weakest area in this thing. The dispositive issue is whether the IRS provided a reasoned explanation for its abrupt policy shift under the Administrative Procedures Act State Farm standard. The court found that Notice 2025-42 was fundamentally deficient. IRS's explanation was deemed cursory and insufficient to justify abandoning a decade of established precedent. Crucially, the IRS failed to account for the massive reliance interests of taxpayers who had already structured complex multi-year energy projects around the 5% safe harbor. The court also rejected the government's attempt to use extra record, so we say industry speculation, as a substitute for a reasoned explanation. As a result, the court granted summary judgment to the plaintiffs and ordered the nationwide hold on Notice 2025-42. Again, finding that the only way to grant some of the plaintiffs' benefits was to simply say, IRS, this doesn't count. These projects can go forward. Now, the practical problem is we are so late in the game that I don't know anybody who wasn't going forward assuming they'd be able to challenge this notice and get the 5% rule in is going to, based on this single case that still has to go through potentially the Court of Appeals, could go to the Supreme Court, that this is going to make you feel a whole lot better about doing it. So I'm not sure it's going to make a huge difference, but it does look at, the limits of what the IRS can do. But you got to be an eligible plaintiff, and I think that's going to be the big problem. So again, we have our infographic there. It's going to outline why the court ruled against the IRS, that it violated the state farm standard, was arbitrary and capricious nature of the notice, and the big thing was they confirmed standing for the plaintiffs under economic rules. Now, we see how we restore the 5% test, right, as a valid harbor alongside the physical work test, and finally the right side explaining why the court issued a broad universal, bar on the IRS using this notice rather than limited protection, noting the procedural deficiencies and the need to protect the reliance interests of all taxpayers outweighed any potential interim market confusion. I just don't know that a confused market is going to be one where people are going to go forward with projects if the only thing they can do is make it work if they get through the 5% test. Okay, our fourth major development, we are examining a significant Fifth Circuit decision regarding the bona fide sale exception under Section 2036A, family and a partnership case. This case is the estate of Ann Milner Fields versus Commissioner. Case number 25-60403 from the Fifth Circuit came down on June the 8th, 2026. This case addresses whether assets transferred into a family limited partnership shortly before the decedent's death can be excluded from the gross estate when the transfers appear to be primarily motivated by tax reduction. In essence, do we bring in the assets or do we bring in the discounted value of the interest that she held? This ruling serves as a warning to practitioners about the intense scrutiny courts will apply to post hoc, after the fact, justifications for estate planning structures created during periods of terminal illness. The courts are going to be skeptical about why you really did it. That's what's going to happen. So let's take a look at the background of this case. The decedent, Ann Milner Fields, was a successful businesswoman whose health declined significantly due to Alzheimer's disease. Her agent and great-nephew orchestrated the transfer of approximately $17 million of assets into a newly formed family-limited partnership, AM Field LP. And the timeline here is critical. The partnership was formed in late May 2016. The bulk of the assets were transferred by mid-June, and Ms. Fields passed away on June 23rd of 2016. So basically within a month, all of this took place. The estate then filed a return valuing her partnership interests at a discounted, in this case, flip my slide there, $11 million, right? Obviously, the IRS audited the return, and they said, no, all of the assets come back in at their full value. And then they added, additional tax on top of that, plus a 20% accuracy-related penalty. Now, essentially, to fight the transfers, to fight deficiency, the state had to prove the transfers met the exception under 2036A. 2036A mandates that the gross estate includes the value of property where the decedent retained an interest unless the transfer was a bona fide sale for adequate and full consideration. The court emphasized that this was a purely objective inquiry requiring a substantial business or other non-tax purpose that was an actual motivation, not just a theoretical one. The estate put forward 3 non-tax justifications: fixing limitations in the existing power of attorney the nephew had, consolidating diverse assets into a single manageable asset, and providing a safeguard against elder abuse. To fight the 20% penalty, the estate also argued reasonable cause and good faith reliance on the professional advisors. Okay. Now, the appeals court rejected these non-tax motivations. Basically, every one of them, they just said, nope, doesn't count. First, the court noted the existing power of attorney was functional, and the new limited partnership actually offered no improvement in succession planning because the management changes still required unanimous consent. It said, so yeah, that first one what the court believes is they just had a bunch of, standard kitchen sink reasons to throw in a flip. And they thought that was thrown in, doesn't make any sense. Second, the asset consolidation argument failed because the assets were diverse and promised no obvious synergies with each other. Ultimately, the extremely compressed timeline proved fatal to the estate's case. The transfers proceeded rapidly just days before she entered hospice. This, combined with the troublesome attorney emails seeking advice on obtaining a deeper discount. Yeah, those emails and all that stuff, they come out, we're in trouble. And of course, it was used for the estate return. So it also means there are complications many times in getting any sort of privilege applied to this because, this sort of thing that was prepared essentially for a disclosure document, the tax return, right? It led the court to dismiss the non-tax justifications as merely, per the court, post hoc theoretical justifications that were there just to kind of, run this through. So finally, let's take a look at the good faith penalty defense. Are they going to be penalized for, this? They're going to pay 20% extra on the tax. The legal standard for negligence under 6662 applies if a taxpayer claims exclusion that a reasonable person would deem too good to be true. The court found that a $6 million immediate reduction in reportable assets on the literal eve of her death, and it's not like we didn't see that one coming, was such an extraordinarily tax avoidance opportunity that the executor should have recognized it as being potentially too good to be true. Furthermore, the estate couldn't even prove the accountant actually advised them to use the specific valuation method. The evidence only showed the attorney discussed the general tax benefits of a partnership. They couldn't show the advisor has actually said this value is good. As a result, the Fifth Circuit affirmed the tax court in its entirety, upholding both the tax deficiency and the penalty. So again, we have our infographic, and again, shows the compressed 30-day timeline right before her death, which was a huge problem. This is the thing that's going to get the attention right away. Okay. It also highlights a smoking gun email address where the attorney explicitly sought advice on obtaining a deeper discount. That's the real reason we're doing it, right? The court's always going to kind of believe that, but putting it in writing didn't work well when that writing was found in discovery. And so the court dismissed the non-tax reasons as merely theoretical excuses that were simply boilerplate stuck on, to try to make something, seem to fit. And finally, it depicted the $6 million valuation discrepancy that triggered the penalty. It emphasized the court felt the transaction was too good to be true. And so, the estate shouldn't have just blindly gone forward with it. And they should have got actual advice, because apparently they didn't really ever get anybody to really advise that this was a good valuation. Okay, the next case is the Schumacher versus Commissioner case, Tax Court Memorandum Decision 2026-47, issued on June the 9th. This is a tax court memorandum decision that deals with hobby losses under 183 and related accuracy-related penalties. Now, this case involves taxpayers running a horse breeding operation, the absolutely standard 183 case. It provides an excellent look at how the court evaluates a taxpayer's profit motive using the regulatory factors, as well as the requirement to successfully mount a reasonable cause defense against accuracy penalty based on reliance on a tax profession. Okay. In this case, the Schumachers, Keith was a veterinarian, Rhonda was an educator, and they started a horse breeding business, sole proprietorship, in 2001. Now, they invested heavily in this operation, including building a $230,000 indoor riding arena. Remember, the operation never achieved a single profitable year from its inception in 2001. For the tax years in question, which were 2017, 18, and 19, they reported Schedule F losses ranging from roughly $129,000 to $165,000 annually. Furthermore, they routinely commingled their personal business funds, using personal accounts for overdraft protection and directly paying horse expenses from personal funds. The IRS audited this return, which showed losses for going back, at this point, going back 19 years, looking at 17 through 19. So we have 19 years of losses, no years of income. Not surprisingly, the IRS disallowed the losses, claiming under Section 183, this was a hobby. Not, basically, there was no profit motive. And they also assessed the accuracy-related penalties under 6062. Now, because the taxpayers had consecutive losses, they were way past being able to use the 183 safe harbor presumption for, these sort of horse breeding businesses, and the burden of proof and retained the burden of proof to show a good faith expectation of profit. The tax court evaluated the activity using the 9 non-exclusive factors outlined in Treasury Regulation 1.183-2B. A critical finding by the court was regarding the taxpayers' record keeping. While they kept handwritten notes and bank statements to give their enrolled agent for tax reporting, they did not keep formal books and records for the purpose of evaluating business performance, reducing expenses, or increasing profits. The court didn't like this lack of business-like record keeping. Along with commingling of funds, it heavily indicated a lack of a true profit motive. Looking at the 9 factors, and the 9 factors in my mind have always been a nice window dressing, but what the courts always tend to be looking at: have you had continuous losses? Do you make a lot of money so you can use these losses to offset income, and you're not really having to make money in this operation? And does it seem enjoyable? If all of those are true, you're probably going to lose the case. That's generally been the key. The court highlighted the 18 years of continuous losses, which far exceed any normal startup phase for a horse breeding operation. Typically, the court looked at economic evidence, suggested 5 to 10 years. By the 10th year, you should be able to be making money from your horse breeding operation. They clearly had gone well past that limit. Because the taxpayer had substantial primary income from their day jobs, what I tell you, key issue, they were able to easily absorb these losses, which suggested the activity was providing a tax shelter benefit rather than being run with profit intent. They also noted the high elements of personal pleasure and recreation involved for those longtime hippophiles. Of course, I like to use words like that, right? They're horse people, right? As a result, on the merits, the tax court sustained the IRS's disallowance of the Schedule F losses. But despite losing on the deductions, the taxpayers won on the 6062 penalties. And this is it, because remember, the last case they didn't. This one was different. The IRS was again looking to impose that same 20% penalty, this time for a substantial understatement of income tax under 6062A. Remember, if it's more than $5,000, or 5% or 10% of the tax that should have been on there, right? And that 5 or 10% depends on if they have 199A activities. You automatically have the 20% 6062A substantial understatement penalty unless you can show reasonable cause. So the taxpayers are arguing they had reasonable cause and acted in good faith because they claim they relied on their enrolled agent of 20 years, Robert Cruz. Now, the court applied the 3-pronged neonatology test to evaluate this reliance. Did you consult an experienced person, right? Who appears to have the background to do this? In essence, so was he competent? Mr. Cruz was an experienced EA who advised them on 183 compliance specifically. So here is a experienced advisor, apparently competent, who you specifically asked about whether or not these losses were considered valid under the IRC. Furthermore, Dr. Schumacher provided all requested information, bank statements, handwritten notes, without withholding any facts. Because of his full disclosure and good faith reliance, and the fact that Mr. Cruz was not promoting the activity, remember neonatology, we had that too, the court ruled that Schumachers should not be saddled with the penalties and waive them entirely. So now, this is a case where the advisor presumably was cooperating and was agreeing that he had been told this, because usually you need to have him say that, yeah, they asked me, and I told them every year I thought this was good. Now, that may cause him some problems if for some reason now the service wants to go, but usually they're not as apt to move there. And it definitely, means that there's not going to be as big a problem with, claiming that we were given bad advice and we paid all these penalties. They paid the tax and the interest, but, they got out of the penalty, which was good news. So the infographic for this one pretty much is showing the bad news on the left side, why they couldn't get the profit motive to work. And the good news on the right side, which is why, despite all that, we still could get all the penalties waived. And that's it. We had 18 years of continuous losses, didn't have any good business record keeping, and it was an enjoyable activity. But the penalty relief, and this is important, clients need to understand this. They relied on a competent, independent professional, right, who had a background. They understood that. They fully and honestly disclosed everything to this person, provided them with all information that he asked them to make this evaluation. Now, again, your client doesn't have to know for sure what they have to provide you, but they can't be a total idiot, shall we say, and ignore the fact that bank statements probably be helpful to see if you made money, but you do need to ask them for the data. And they need to have actually asked you about, is this okay? They did. So because of that, they met the test found in neonatology, independent advisor, no interest in the activity. He's not being paid because if you go ahead with it. And, you gave him all the data he requested. You're not required to figure out if he did it right. Now, I always warn people, though, that doesn't mean that you can opinion shop. If you're opinion shopping, that tends to be done as bad faith. So, had their EA told them that, this is going to qualify, they can't keep going from EA, CPA, et cetera, all over town, trying to find somebody who will say it's fine. If you do that, you're probably going to lose. Right? That'll be one of the problems. And obviously the IRS will be looking at, did you change advisors about this time? And if you did, did you ever ask the prior guy about this issue? And what'd you do? And usually there's all this stuff and all kinds of records that you changed because your prior advisor wouldn't do it. So you went to the new one. None of that was here. He had a long time. They had a relationship with him apparently before they did the horse business. So reliance on him made perfect sense. Okay, next, this may sound like just a bit of a rerun because we had a very, very similar case not all that long before. This is the case of the Wells versus Commissioner, tax memorandum decision of 2026-49. This is a harsh lesson again in why you've got to have a proper contemporary written acknowledgement for charitable contributions, because it is harsh and it's statutory and it doesn't give you much leeway. You've got to do exactly what the law says. And yet again, we're going to find somebody who doesn't. So this is a very large non-cash charitable contribution. In 2016, the taxpayers transferred a $4.42 million piece of property, the former Chamberlain Hart Academy in Mississippi, back to CHA, the Academy, via a quitclaim deed. The taxpayers' CPA of 30 years, Dennis Long, explicitly instructed them to get a contemporaneous written acknowledgement from CHA's president. However, the CPA mistakenly advised that the letter merely needed to thank them for their gift and acknowledge the appraised value. Okay, at this point I will tell you that's bad advice, but it's also not going to get out. You can't get out of this thing with reasonable cause. It's going to be a problem. The resulting letter did exactly what the CPA had told them, but crucially omitted the required specific disclosures regarding whether any goods or services were exchanged. That's important to have in there. This error caused the IRS to disallow $4.4 million carryover deductions claimed for 2019, 2020, and 2021. This thing tends to have a knock-on effect, which it did because of the carryovers. Right. The tax court reiterated the unforgiving nature of the rules found at IRC section 170F8. That section demands a contemporaneous written acknowledgement for any contribution of $250 or more. The court highlighted that acknowledgement must state whether the donee provided any goods or services in consideration for the gift. Even if absolutely no goods or services were provided, and we can prove that, the written substantiation must still explicitly include a statement to that effect. Right? In essence, the court made it very clear, noting the doctrine of substantial compliance does not apply in this context. We have seen that stated by the courts multiple times. There's no close enough. This is not horseshoes in this area. Failure to supply a satisfactory CWA completely bars the deductions per Congress. To try and save the deduction, the taxpayers creatively argued that a series of documents, including donation letter, the deed, Form A283, and the flawed acknowledgement letter collectively satisfied the rule when read together. And the tax court had suggested in prior cases that you could piece it together from multiple items given to you by the other party, the recipient of the gift. Okay. So the court now acknowledged that precedent that multiple documents can form a single CWA, but it noted a substantial limitation here. All relied upon documents must be executed or acknowledged by the donee. You can't rely on something that was not coming from the donee, acknowledged by a donee. In this case, the donation letter and the quitclaim deed were signed by Mr. Wells on behalf of the donor. The court completely rejected the argument that his dual role in the transaction mitigated this, noting a proper CWA must come from the donee organization. Therefore, the court could only look at the documents the donee, actually acknowledged, the acknowledgement letter and the Form 8283. However, because neither of these documents explicitly stated whether goods or services were exchanged, they failed the statutory test. His argument was, that essentially the donation letter and the quitclaim deed showed he didn't get anything. The court said, no, those can't be counted. Nothing here states this, right? They also dismissed the argument that the matching financial value of the deduction and the appraisal inherently prove no goods or services were exchanged. Implied fact cannot replace strict substantiation requirements imposed by Congress. No good. So on the merits of the case, the court concluded that the taxpayer entirely failed to satisfy the strict requirements. Don't satisfy them, no deduction. So IRS disallowance of carry deduction was based on that ruling. And because of that, they didn't even consider whether the valuation of the property was accurate. It was irrelevant. However, the taxpayers did get a victory regarding the 20% accuracy penalty. They raised a reasonable cause defense under 6664C1. That is right. You can make that work here, right? By proving good faith reliance on a tax professional. The court noted that Mr. Wells exercised diligence by explicitly mailing his CPA of 30 years to ask for clarification on exact requirements for CWA. Because he ensured the letter included everything his accountant mistakenly advised was required, the court overruled the penalty. And as we've seen from those cases we've had with, the issue involving the easements, right? The conservation easement deductions. It's probably a good idea that they didn't look at the valuation of the property. Because remember, if the court had looked there and determined the property was actually only worth less than half of that, then there would be the 40% penalty for which there is no good faith, reasonable cause relief. So it's probably best they didn't look there. I'm not saying it wouldn't have held up. Hopefully it wasn't overvalued dramatically, and hopefully, that wouldn't have been a problem. And I have to assume backdoor the court really didn't seem to probably think it was likely it was, or they might have looked at that valuation to see what's there. Our infographic, again, the visual summary, we look at all the fatal flaws in substantiation. Whenever a client makes a substantial charitable contribution, make sure you have strictly followed Section 170F8. Look at it, get it in front of you. Don't go by memory. My guess is the CPA probably went by memory or just general, reasoned it out, which I've always is a problem because we have the law. You don't need to quote reason it out if the law tells you exactly, which this one does. So for whatever reason, it wasn't bad faith. And, it's just one of those things, though, that when you're talking about a $4.42 million donation and you understand that in donations, which is part of the reason why we highlight these cases, that the IRS is, not the IRS even, the Congress is extraordinarily picky about what you have to have. You want to make sure you're there. Now, the verdict did give us a minor silver lining. We got out of the 20% penalty because I'm sorry I misstated that earlier, but this is one this penalty can go away. What can't go away is the 40% gross valuation, gross valuation penalty on a charitable contribution. And that's what we've seen when we talk about the conservation easement cases. Okay, so let's go to the final topic. We're going to a preview of regulatory framework for the brand new Section 725F Education Freedom Tax Credit. New and improved, right? So this is from a news release, which is Treasury Previews Education Freedom Tax Credit Guidance issued by Department of Treasury on June the 10th. With that, they also released at the same time with the release a fact sheet and a copy of statements made by an executive in Treasury. So we'll talk about all of those here today. Now, for us, this signals a complex new area of compliance that will involve tracking state-level elections, overseeing scholarship granting organizations, SGOs, if you work with them, and navigating a unique new donor reporting requirement. Okay, so what's the Section 25F credit? Right. The basic mechanics of this new credit, it was established under the Working Families Tax Cut Act inside of the One Big Beautiful Bill Act to incentivize private contributions that expand kindergarten to 12th grade educational opportunities. The law allows individual taxpayers a federal tax credit of up to $1,700 for cash contributions made to eligible scholarship granting organizations, SGOs. It's important to note that this is a state-by-state initiative. First key rule, a state must voluntarily elect to become a covered state, participate in the program. At this point in time, we are just barely over half the states, which means about half the states don't. So you've got to check and see if your state's gone in or not at this point, because that's going to be important. And states are going to have to get on if they're going to get in from this point forward. Participating states are required to provide a list of eligible SGOs to the IRS by January 1st of each calendar year. So the deadline is going to be January 1st of 27, apparently, to make a contribution in 27. To get the credit, the taxpayer must make their contribution to an SGO that's officially on that list. And it's supposed to go live on January 1st of next year. So again, about half the states. Now, they didn't say how much the population of the U.S. that covers, so I'm going to presume it doesn't cover half the population. Right? I'm just going to say I'm working kind of on that assumption because 27 is barely over half, and if many of those states are smaller, then yeah, larger states. So you want to check and see whether the states have gone along with it. More importantly, whether the states your clients live in have gone along with it. Is it available for them? Okay, now, an organization that wants to qualify as an SGO, scholarship granting organization, there's a rigorous operational and accounting standards to be put in place. One major hurdle is a requirement that SGO must spend at least 90% of the income organization on scholarships for eligible K-12 students. To make this less burdensome, the Treasury imposing a state harbor where income is measured purely by the funds held in a specifically designated Section 25F segregated account, which includes qualified contributions and any earnings on them. Additionally, if an SGO operates in multiple states, they must be located in that specific state, meaning they've clarified that term under the law. They have to be authorized to do business there, comply with local charitable organization rules such as fraud prevention, and maintain a separate 25F segregated account for that state. The organization is going to operate in 10 states. It needs 10 segregated funds. And if they do things besides 25F scholarships, they're going to need to have all those funds separate from their other funds. So there'll be a little bit of accounting here to worry about, shall we say. And there's also an audit mandate, okay, to prevent fraud and abuse in the program and to reduce the burdens on the states because they have to administer this program. They'll be subject to strict oversights and they'll be responsible for verifying student eligibility. So each SGO must obtain an annual financial and programmatic audit conducted by a qualified independent third party, and this report must be provided to each covered state where the SGO operates. However, the proposed rules may allow, said may, a streamlined alternative for smaller SGOs, we're not told what smaller would be, permitting an internal committee unrelated to management to conduct the audit under the penalties of perjury. On the eligibility side, the credit targets households making no more than 300% of the area's median gross income. The SGOs will carry the burden of verifying this. The Treasury expects to allow them to use documents like pay stubs, W-2s, tax returns, IRS transcripts, or even commercial data sources to basically support that numbers. And foster children may be treated as automatically satisfying this income requirement, so under the proposed guidance. Then finally, there are privacy protections and reporting mechanics for tax professionals need to understand for individual clients. Donors will not be required to hand over their Social Security number directly to the SGOs. Instead, the SGO will issue written acknowledgments of annual contributions using a unique donor number generated under an IRS-approved provided method to be defined. This allows the IRS to accurately match the claimed credit to an actual donor without compromising privacy. And also why Section 25F governs a credit, Look out for separate regulations coming under Section 530, as Treasury extends for those scholarships to be permitted to cover additive academic tutoring and special needs services. Proposed regulations, and they borrow 530 rules for part of their requirements, proposed regulations are expected in September of 26, and the program will launch in January. So we're going to find out with less than 4 months left to go in the year, how exactly this is supposed to work for these organizations. And they got to get qualified. And the states have to understand how everything's supposed to work. And they got to get that list together by January 1st. This is a tight timeline. Make it that way, okay? So we got our final infographic. It is a guide to the requirements of these new, implementations. The top half is the heavy compliance burdens based on the SGOs, including the 90% spending mandate, right, for segregated accounts, independent audits, and their duty to verify the student household income doesn't exceed the 300% median threshold. The middle section breaks down the taxpayer requirements, living in a state that has voluntarily opted in, the maximum $1,700 annual credit for cash contributions. By the way, this you can't get this credit if you're using the same dollars to try to claim a state credit. So, you can use dollars for state credit or federal credit, but you can't use the same dollars for both. And your unique donor number, the UDN, reporting system to protect taxpayers' privacy. And the bottom timeline gives you a very rapid and compressed implementation timeline. Proposed regulations in September to launch on January 1st. We're going to have things go pretty quick here. Okay. Well, that concludes this week's review of the developments for the week of June the 15th, 2026. Thank you for coming in here, listening today. And if you have any further questions or you want to, ask some more issues on this, you can reach out using the email address on the screen, ed.zollars@currentfortaxdevelopments.com, or in the copy of the slides you can download from our website at currentfortaxdevelopments.com. Go to the weekly update version. You'll see the one for this week, and you can download that. I do keep an eye on various state society websites, where I can monitor some discussion forums. The ones I look at, and memberships for most of these, is going to be the Arizona one, Arizona Society, New Jersey, Illinois, Minnesota, Idaho, and Washington. So you can get those in there. If I see your question, I might respond with an answer. So, look in there if you wish. Otherwise, we look forward to it. Now, as I said, next week I will be returning. I will come back in on Saturday. Usually should be in the early evening on Saturday. That's going to be a very compressed Sunday. So if I can get everything drafted while I'm in Atlantic City, or even on the way back, maybe I'll be able to get things recorded on Sunday. We're just going to have to see how well that works. So fair warning, just in case we miss a week. You'll understand that I'm under kind of a compressed timeline. So we'll be doing it. But otherwise, we will see, if not then, not next week, in 2 weeks, on current federal tax developments.